Mike Tedeschi, Wealth Management Advisor, Perspective Wealth Planning. With this week's market breakdown video, we're going to take a look at the four major U.S. indexes. We are also going to take a look in at the U.S. dollar as well as commodities. And in this video, we are going to focus in on a phenomenon that we've seen happen lately, which is selling into the close. In fact, the pressure in the last hour of the day, we've had the biggest 3-month drop in the last 25 years. I want to take a deep look at what that could mean for us, and we are also going to take a good look at breadth readings as well. So let's jump right into it. First and foremost, let's take a look at the S&P 500. And what we can see right here very clearly is we are making new all-time highs. Again, when we look at this chart and we really break it down, and we've talked about this for a while, even though we've had some weakness a few times this year, we have not made a lower low on the S&P 500, and we continue to drift higher. Until that changes, everything technically looks fine. We take a look at some of the other indexes. We can see very similar setups here out of the Dow being the strongest. We've talked about that rotation from growth back into value, higher low, holding above the previous breakout up here, making a new high there as well. So the Dow continues to be very, very strong. And when we take a look in at the Russell had been a leader here until about 2 weeks ago, and still we have put in higher lows, so we have held the zone that we needed to. We have a all-time high, the closer time frame than on the Nasdaq, but still a little bit more to prove there out of the Russell. But again, it had such a move from the breakout in last November. Some sideways action here would certainly be well within the norm. Now the Nasdaq, we had saw a lot more weakness in here over the last month or so, but it held that major level. I mean, we haven't changed the levels in on these charts for you guys. We talked about how important this zone was. We held it. Now we're pushing right back up in towards that resistance zone. So what happens here at that 13,300 zone is important. If we break back up above that, I would expect this to go back up and test that all-time high, and that, of course, would be bullish. Now, we have mentioned a lot lately about the U.S. dollar and the importance at the level in which it is at. Now, I'm going to put the 200-day moving average in on my chart. It's not something we look at very often, but when I see an important test of that 200-day moving average happen, certainly want to highlight that. The U.S. dollar traded underneath the 200-day moving average for almost a year, and beginning of last week, it did make a move back up above it and is still above the 200-day moving average at this time. When we pull the chart back and we look at a multiple year chart, what we can see is where the U.S. dollar has bounced from is very, very key. This is 5-year support, that 89 zone. Now, for the dollar to continue to get going and to negate the downtrend that it's been in for the last year, we need to make a higher high. And so we need to get up over this 94.5 zone before we can say that this really has bottomed, right? This is very easy for this to come right up into this area and fail and continue its rollover. Right now, the U.S. dollar, when we really look at the longer time frame chart, is trapped between that 94.5 and that 89 zone. The winner of this is going to give us the next move out of the U.S. dollar. So while it is over the 200-day moving average for the first time in a while, it's still pushing up into this resistance zone, and it has not made a higher high since we started selling last year. So what happens here is very, very important. And when we come in and we look at commodities, we can see how important this zone really is. The U.S. dollar started to make that bounce here a few weeks back, and you notice things like oil ran into resistance and started to turn back. We look at the pressure in on the precious metals. Gold holding on to that 1670 zone. This chart does not look nearly as good as it did a few months back, right? It's hanging on to the last kind of vestige of support underneath here. That would not be a good sign. We come in and we take a look at silver. Silver is holding right on to that 24 zone of support right in here. A move underneath of that would target 22. And I think what happens again in the U.S. dollar is definitely going to have an implication here. Copper, when we come in and take a look at it, It's holding up right around that $4 zone, still holding over the breakout level. Again, if the U.S. dollar continues to see strength, that would be a headwind for commodities. But as it is right now, we're at a key level in a lot of these things that we're taking a look at. Platinum is still holding over its breakout zone that we talked about back at 1,050. It looks a lot more like the copper chart than silver or gold does. But the best looking chart right now out of the precious metals space is that palladium. We talked about this multi-month base underneath 2,500. We broke up above that last week or 2 weeks ago, and we have held above that 2,500 zone. We're going to look for this to continue to follow through to the upside. It's the closest metal to its all-time highs. It's just a fraction away here. Up above that, again, would continue to be really bullish in on that space. The last thing that we want to look at when we're talking about our commodities in U.S. dollars, let's take a look at the emerging markets. Right, we talked about how important it was that it held over that breakout level at 1277. That's exactly where it pulled back to, and it's starting to make that bounce. So if you're watching the emerging markets, this is that really, really key level underneath of that. We need to take a different approach. As long as it stays above that, we still do look pretty good in that space as well. And some of the individual economies around the world are doing much better. I highly suggest you take a look at some of the individual countries, and you can clearly see the leaders from the laggers at this moment. And we speak a lot about breadth in these videos because I think it's very, very important. Just because the indexes are holding up doesn't mean what's going on underneath the surface is necessarily great. And when we take a look at the Nasdaq McClellan Summation Index, we talked about this 200 zone potentially being an area where we'd see that turn back up a week ago. Well, you can see what's happened. Underneath the surface, we still have a deterioration. We're actually below that 0 point. Now, what I will say, given today's price action while I'm filming this in here on Thursday, it looks like we could be actually starting to turn that corner right here, and that would be exactly where we did that last November. So holding this minus 100 zone on the Nasdaq is actually really, really important. If we do hold on right here, I think even though that we're below the 0 point, we're still probably in pretty good shape. So we're going to continue to pay very close attention to what happens here, because again, the breadth reading underneath of the surface is really, really key. Speaking of breadth readings underneath the surface, let's talk about where we're at with the indexes versus new highs. This is what we're seeing when I'm talking about breadth underneath the surface not acting the way that we would want it to. We can take a look at the New York Stock Exchange up issues against the indexes, and what we can see is despite the near highs or now new all-time highs, they're in the S&P 500, we have the fewest up issues at that point in time since 1946. All right, that right there is quite concerning about what's going on under the surface. Another way to take a look at this data is we can take a look at the New York Stock Exchange up issues percent with the S&P 500 within 0.25% of a 52-week high. On average, you see somewhere around 56% of the issues being up. All right, what we saw on Monday was 33%, a very, very low percentage historically going back when we take a look at this chart. All right. This data, by the way, goes all the way back to 1928. What we're seeing here underneath of the surface is breadth readings are not looking that great. So the indexes continue to head higher, but what's going on under the surface is still a little bit concerning, and that's why we're really paying attention to what's going on with breadth here. When you take all of the signals from the last histogram and you actually plot them, we can see here over the next couple of months we have a negative skew, and even a year out we have a negative skew to the S&P 500, right? So if the indexes continue to push higher but there's less and less things leading us to that high, that oftentimes has preceded some pullbacks and some turndowns in the overall market. When we look at all of those signals going back to the 1920s, we can see they're not horrendous. They're just a little bit below that 50 percentile, but we do have some large pullbacks in there, and it does make sense. But I do want to note, I mean, there are still some times where a year later we've got some 30 and 40 and 50% gains there on the S&P 500. So it's not the end of the world if the breadth can pick back up, and that's why we're paying very close attention, again, to what's going on with breadth underneath the surface. Now, there's one other thing I really want to talk about in today's video, and that is the persistent selling pressure into the close. Now, one of these phrases you may have heard over the years is bear markets open strong and close weak, bull markets open weak and close strong. And part of the thought process behind that is the last kind of half hour of the day, that's where the smart money tends to make those positions. So seeing strength into the close means people are willing to hold risk overnight, and that's usually a good sign versus the other way around. And what we've seen here over the last few months is the last hour cumulative selling pressure into the close has had the biggest 3-month drop in 25 years. All right, and what that's saying here is over the last few months, the last hour of the day, there has been a lot of selling pressure, which typically is not necessarily a great sign. But if we break down and actually look at the numbers of all of the indicators where we have this phenomenon playing out, we can see, again, they're not terribly negative. But when we put all of the things that we've taken a look at, it looks like the next month or two we're probably in a potential where we could have some more difficult times. But again, we look a year out on that the last hour 3-month change indicator. A year later, it doesn't really make a difference. It is more in that short term where we are seeing that weakness. What becomes a bit more concerning is if we take a look at this data in a different way, where we compare the 52-week high as well as the last hour 52-week low. So now we're taking a look at that breadth and that pressure reading. There's not as many signals here. There's only been a couple of signals actually before this year, but what happens in the next 2 months, we're only positive 17% of the time. 3 months later, it's been a negative 100% of the time this has showed up, right? And we can see when that has happened in the beginning of 2020, right before the market pulled back, as well as that sell-off there in 18. So this data set only goes back to 1993. There's not a ton of signals in there, but again, it's those signals that kind of approach and show up near the tops. But if we do look 1 year later out, again, we are positive a high percentage of the time. So we take all of what we've taken a look at here today. Breadth readings underneath the surface are very, very key. Historically, when we see some of the readings that we've seen, we've struggled over the next couple of months, but we're fine 6 months, a year out. So what happens here today and in the near future in terms of breadth readings is definitely going to have the biggest impact on whether or not the next couple of months are positive or negative there in the markets. As always, I hope you guys find this information useful. If you have any questions, please reach out to me at mtedeschi at perspectivewealthplanning.com, or you can give me a call at 814-580-9881. I'd love to hear from you guys. I'll see you all next week. Take care.